Unrivaled Nation. So earlier this month, I talked about how my potential multi-bagger for this month was a stock that I started buying called CDON. I also mentioned that I was looking at another company that I thought also had multi-bagger potential. So it's not my official multi-bagger of the month or anything like that, but it is a stock that I think has potential, and I actually started a starter position for myself today. Now, it's run up quite a bit, and I let me not get ahead of myself, but I'm going to give you, this is the exclusive take on Green Thumb Industries, and I'll walk you through it. Now, I'm still planning on doing an exclusive video on CDON. That'll be later this week, is my intention. CDON is a larger position than this. This is just a starter, I'd say, at this point. But let's go into Green Thumb so you can learn a little bit about this, what I think is a very exciting hypergrowth company. So first of all, what is Green Thumb? It trades. So this is the added benefit for some of the Journey, subscribers. Part of the Unrivaled Nation is that it trades pretty heavily in the U.S. under GTBIF, but you could also buy it directly through the Canadian exchange, GTII, in Canada. So what is Green Thumb Industries? It's a vertically integrated cannabis company where they manufacture their own goods and sell in their own retail locations. Now, you might be thinking, like, cannabis, isn't this just some sort of hyped up potential? No, this is actually a real company delivering real products with real brands, real channels in which they sell, and growing at a very fast pace, and they're profitable. So this is like, wow, this is not what I expected from what I traditionally think of as sort of a shady field. Regular Journey subscribers know that I was previously invested in another cannabis-related play that helps with homegrown products, and I thought the management there was kind of shady. I don't get that vibe at all from this management, where they're focused on return on invested capital, and they seem like very straight shooters. But so what's the story with Green Thumb? So vertically integrated, meaning everything from the cultivation, manufacturing facilities to the distribution, multiple types of distribution arms in multiple different markets, to owning the retail channel, the end. How is this sold at the end state, where they have their own retail platform, several different dozens of stores in which they sell. So let's go into each of these components, because it's a combination of manufacturing their own goods, having their own channel to sell it, and the end location in which the goods are sold, and their own branded goods that they're selling. So first of all, 30% of their revenue is effectively these brands that they've either acquired or own just outright. And you can see some of these brands in the type of products that they fit, whether or not it's topicals or edibles, vape or flowers. And you can see how it sort of breaks out into these different groups, and you can see how these different groups have been growing over the prior year. And so this is, it strikes me as interesting to see these brands, and this is what I'm excited to see, because when you're looking at a developing industry, people haven't really set their preferences yet. So if you do heavy investment on not only owning the retailer but also owning the brand, you do create this sort of optionality that you're going to get a recurring customer in the years ahead, if you're able to create that favorable experience where they're like, oh yeah, I have this favorable brand association when I want to consume cannabis, and here it is. It's the chewables from Incredibles, or it's the pre-rolls from Dog Walkers. So this is a very interesting segment, and generally with brands you can get better margins. So that's another thought process to think about. But that's only 30% of their business. Let's peel it back a little bit with these brands. You see Dog Walkers, this cannabis pre-rolled, where, going to Weed Maps, which is another video I've done previously on YouTube, where it has 5-star reviews, a total of 10 reviews, which isn't that many. But what I like about each of their brands is that their brands are trying to target a very specific niche and sort of saying and create a very personal feeling to it. It's not just, hey, here's some marijuana, here's some cannabis. It's, let's make sure you're having the right experience. And so this whole Dog Walker brands is like the mental association of the leisurely stroll while you're walking your dog, and that positive association people have. And to sort of help build that community aspect is that each purchase supports animals in need. So they're like, hey, you buy this and you're also making the world a better place. And so I like that they take that angle with each of these brands. I think that type of positive branding could have the effects of establishing a real brand that creates real loyalty over time. I don't think they're there quite yet. Just based on sort of anecdotal aspects where you only have 10 reviews on Weed Maps. That's not a crazy amount. Now maybe I'm just misreading it, but that's how I'm looking at it. But 10 5-star reviews is still a net positive data point. And if you read the reviews, a lot of it's like, wow, this is high quality stuff. The one was a cancer patient saying, this is exactly what I needed. So I'm liking reading what I can about the brands that they've established so far. Another aspect, about 70% of their revenue, so if 30% comes from the consumer packaged goods, another 70% comes from their retail. So that's actually how they're selling these items, and it's through this Rise brand. And so they have several dozen stores already open, a national footprint across about 13 markets. And what's incredible is their growth rate, 65% same-store sales growth, which reflects getting a lot more volume going through their stores. Now, part of that is you have legislative changes in some markets where maybe, hey, they're in Illinois and it's just for medical, and then Illinois approved adult use. And because they already have that infrastructure set up for medical consumption, now you get all the adult users. You get a dramatic increase. So there is that sort of aspect that drives the growth here. But they're calling out a pipeline of licenses to more than double open stores. That's a comment worth thinking about when you're thinking about their growth rate in the near-term future. But by the way, this is a fantastic number. Same-store sales 65% plus. I mean, you look at like any type of normal store, you're looking at single digits, plus or minus. This is riding a big wave of potentially legalization. So far, it's state by state, and you're creating this sort of direct conflict with the federal government because federal government says it's a substance that effectively you cannot sell on a federal basis, but on a state we're like, hey, we can do this. So this does need to get sort of figured out in the future, but right now it's state rules and states are making the market. And we'll talk a little bit more about that in a minute because I think it reflects a big opportunity. So why vertical integration where you own both the retail arm as well as the brand? And so here's an interesting comment from management where they go, there's a 1 + 1 = something bigger than 5. And we're focused on building our brands and the relationship with consumers. So that's about being where consumers are. The being where consumers are, I think, is a really interesting comment because it reflects the fact that this is a rapidly evolving situation. Look, they're growing hyper fast. They've grown from just a few $1 million to hundreds of millions of dollars to potentially billions of dollars in the years ahead in terms of revenue. So I think by saying, look, we want to keep our fingers on the pulse to see what's actually driving this market in each of these submarkets. Like we can see the very local detail of what's actually the inventory that's moving. So let's see what our competitors are doing. Let's see what products are selling, because that also affects what type of brands they want to be selling. I think this is a super smart strategy where they want real-time information of how should they adapt to the environment. And they later go on, and isn't it a pleasure to own the booze and the bar? I think that's a great comment. I don't necessarily think that they will always be like this. If cannabis really does develop in the coming years and decades, I think there's a good chance that there's opportunities for effectively two separate companies here. One is the retail arm and one is the consumer products. There's a good chance that is a development that would happen several years out if Green Thumb continues to fire on all cylinders. So let's keep going. They talk about how it's a different kind of business to build a store for $1 million in revenue and build an e-commerce platform where there's 50 million, and dealing with the supply and demand from consumer markets and individual states and how they love both of their businesses. I think it's a smart move for now, what they're doing. Building brands, I think, is super smart. It's about getting dog walkers to every consumer that wants them. Dog walkers is their pre-rolled brand. It's a very easy message. So what is this actually translated in? And holy smokes, look at this revenue from a few $1 million in revenue to over $500 million in revenue for 2020, their estimate. Consensus estimate, so this is 170% growth from 2019 to 2020 year to date. And then there's the consensus. So they're using what Wall Street, based on a couple of sell side estimates, to say, hey, this is what the consensus, this is what Wall Street is estimating. We haven't put out a figure yet, and I think that's very interesting because this could create a variant perception. Because Wall Street's effectively saying, hey, we think you're going to be growing 50 to 70% next year, and they're already growing 170%. So is there the chance for them? And that's a pretty dramatic deceleration, by the way, going from like 170, 100, 150 plus down to 50 to 70%. That's a huge deceleration. So if they're able to actually go somewhere 70, 80, 90% growth in 2021, then I think you're beating expectations, and things continue to do well. And look, we'll talk about the stock price in just a minute. So, what do their results look like? And let me ghost myself, or actually I'll just shrink this a little bit. So there you go. So their results are really developing nicely, where in the third quarter, the most recent quarter, they started showing some real profitability, 37 million in profits on 157 million revenue. I mean, that's real operating margins. Year to date, they're showing something like 30 million in free cash flow year to date. And keep in mind, this is when their debt expense, they don't have a ton of debt on their balance sheet. Their balance sheet is fairly liquid. Their debt costs about 12% plus because there's an equity component to it. And so I think being in a position where they can fund their growth in the years ahead versus anyone else that's going to look to get into this space, that's a unique advantage to have. Having what I'd say is affordable financing, self-financing would be a big component of it. And they're going to get it from either equity or cheaper debt, but we'll talk about cheaper debt as an opportunity in a minute or two. But just starting to see, wow, you're really starting to change the financial profile of this company when you're looking at significant operating margin profitability. So that's really interesting. What else? So it's a wide open opportunity. I mean, look, these are the markets that they're in. They split it up by what's currently adult use versus medical markets. And there's a really interesting element about medical markets pivoting or sort of evolving to adult use, which they highlighted here, or which I quote that I highlight here. Regulations in some adult use markets, such as Illinois, have offered preferential opportunities to existing medical cannabis operators, i.e., if you have a good practice developed in a sustainable way in our communities. We don't want you opening up a bunch of practices that's medical cannabis and just ruining the neighborhood, where it's all a bunch of shady characters and you're not paying your taxes. We want you to keep it a clean brand, a clean experience, where we don't have to be sending the cops every week and you're paying your taxes. Oh, there's a capital windfall for the state or the local cities. That's what they want. You want a win-win. A community win, a win for the city and the states. So what they were saying, what they're hinting at here is because they've done a good job with their existing medical states that only do medical, they got, let's say, a first right to, hey, you know what, you want some more licenses, you want to expand, when we approve official adult use, you get preferential treatment. We trust you to roll this out in an intelligent way. You're not going to ruin our local communities. So I like hearing that aspect, the preferential opportunities. That makes me think that there is a potential advantage here, or at least for continued hyper growth. These factors have allowed us to quickly develop adult use market share in those states. What I was just saying. So I mean, and you look at this map and you're saying this is just what they're in now. Like, if you're thinking that longer term, most Americans are aboard with the idea of legal, adult use, then this could be a wide open market. And that many different states, tens of billions of dollars of opportunity in terms of the market. So that strikes me as super interesting. And in terms of, getting that support, this is one of the things they called out. And in the most recent election saw several states, effectively either approve it for medical or adult use, is that nearly 70% bipartisan support, which is, in an age where the U.S. is continually divided in terms of their opinions on these things. This is something that actually a lot of people are supporting. And honestly, I think the states, especially given that, the U.S. so mishandled their response to COVID, and it's in this complete financial hole that they need to increase their tax base significantly. I don't think you're going to see this when stimulus is, and first of all, the war on COVID, that's like the first priority right now. But I think what you're going to see is that legalization of like, oh man, we have this huge financial gap, we need to fill it. So that becomes a focus, let's say, after the first 100 days, where it's like, okay, we already did our focus on rolling out the vaccines. How are we going to pay for this? And that's where people are going to say, okay, let's, if people approve it, let's just, if most people are fine with it, let's start rolling this out. Now that's a mixed bag, because you don't want sort of a crazy free-for-all in terms of competitive spirits, because then it does crush margins. So it needs to be done in an intelligent way, rolling this out. But I think that's the direction we're heading in, where nearly 2 out of 3 Americans live in states with legal cannabis access. It's growing acceptance, bipartisan support, and the need for billions of tax money. So I think this is an easy win across the board that I expect to get rolled out in the years ahead. I could be wrong, but this is the direction I think we're heading in. Let's keep going. Is it unrivaled? And this is a tricky part, because oftentimes when you're looking at a company that's growing hyper fast, it's not always clear that you're unrivaled yet, especially a fast dynamic market. Things are changing quickly. So, they do call out certain aspects. We have one of the 10 licenses in New York. We have one of the 4 licenses in Connecticut. Things like that effectively say, hey, this isn't hyper competitive because we have the license. We're competing against just a handful of other folks. So it's friendlier competition. So you have data points like that. You have data points like they're doing the right thing. They do this aspect of first day profits for any new stores that they open, which I think is a great way for community building that's going to local and important causes, such as, hey, if someone was arrested for having a small amount of marijuana and they're previously in jail, hey, we think this should be about recidivism, for example, and making sure the community's better off. And let's donate to those types of causes, which makes sense, especially as the legal landscape is changing. So it's not clear to me that they're unrivaled yet. Do they have several aspects that create a strong advantage? Quite potentially. Having that free cash flow is critical, especially when, from a regulatory environment perspective, it's very hard to get cheap capital. This is, I would argue, one of the top players, and they still have 12% plus capital costs from their debt. So I see that, and I'm thinking that is a killer burden for any smaller company, in terms of getting financing. It requires pure equity financing, and being able to self-finance a lot of their growth is a big advantage. So that's one aspect, having that vertical integration where they could see, oh, okay, this is the number of flowers we have, this is how we produce it, we might have a shortage here, so pricing might come under pressure, but you know what, we're focusing on these brands, and in our stores we see that these brands are selling, so we have these brands and we're great, or maybe we market these things that are higher margin, or these other brands are selling quicker than ours, maybe we need to get into that space. So I think there's aspects here that they, by keeping their finger on the pulse in a rapidly evolving situation while growing at a hyper speed, makes me think they could have a either very strong or unrivaled value proposition in the future. A big tell is what's going to be your growth rate in the months, quarters, and years ahead. If they're able to continue up this growth rate, that I would argue is faster than the market, or just as fast as the market, then I'd say you're doing solid. So that becomes the question: is can you grow even faster than the market? And I think they have the key aspects that can do it, but we'll see. This is an evolving situation. Management does talk the right talk in terms of building out a strong value proposition, creating an unrivaled setup where, for example, their capital investments. And if you read the transcripts, you listen to what the CFO and CEO talks and how they think, they're very focused on the right things, in my opinion. For example, in the most recent conference call, they were talking about how their capital investments, they're focused on the ones that can drive down gross marginal cost per unit. I mean, this is like something that, over my shoulder, that's something John D. Rockefeller was talking about, where he was saying, hey, how do I make sure my cost structure is lower than everyone else's, such that if pricing were to get skewed, we could still be profitable while everyone else won't be. So like they're focusing on the right things. They're focusing on not only that, but they're focusing on like, look, we don't try to play the price game, guessing where prices are going to be or trying to jack prices higher or lower, take share. They're focusing on, we try to serve customers. And I think that's absolutely the right mindset. It's not focusing on what's the competitor's going to do. It's, hey, how do we make sure we have the products that the consumer wants or potentially needs if they have a medical condition? And we certainly try to serve patients who are using this product for well-being. Then another comment that he said, we are playing a return on invested capital game in order to grow the chips for shareholders and put them back in a game to understand what's happening, i.e., we're making our money, then we take our profits, reinvest it, and say, hey, let's say, for example, like, some folks will say, well, what are your thoughts on rolling out in this market? And you'll get this sort of playing coy by management saying, look, we take it market by market where we're sizing up return on invested capital. They're not necessarily going to plow ahead, let's say in California, where yeah, sure, it's a big market, but if it's already hyper competitive, it may be a lower return on invested capital. They might say, hey, we have a much better return on invested capital plowing ahead in Pennsylvania and Illinois, for example. So that's, or New Jersey, which recently legalized. So you see these aspects, and I think that's exactly the right mindset. It's not just, see, if they were saying, hey, we want to be number one in terms of revenue, I would say that's a mistake. You want to focus on a player that's thinking about what's the best return on invested capital for this business. It's not just about, hey, how do we just grab as much share as possible if it's, let's say they're doing revenue at a loss in California. That would be a big mistake. So they're saying, hey, where can we spend money and get the best return for our dollars? That way we can plow it back in and keep this, beautiful flywheel going. So, and, they comment, we love our current portfolio broadly east of the Mississippi. So you should understand, there's an East Coast weighting to it. Everywhere we love, we see the flower shortages happening there, and just watching what we call internally the state of the state. So they're looking state by state to see what's going on. But there is, recognition like, hey, there might be pricing issues in the future if there's flower shortages. But that's, I would argue, an advantage that they have as a vertically integrated producer and retailer. Is seeing like, oh, there might be a shortage, there might be pricing issues later on, margins might take a hit. I would view that as an opportunity for long-term shareholders if, let's say, their gross margins were to get hit in the short term because, let's say, there's a flour shortage where they're like, you know what, but we also rolled out while gross margin takes a hit, we also rolled out 12 new stores. Well, are you taking share? Yeah. Are you growing, faster than the market? Yeah. So, you see things like that and you're like, oh, okay, I'm fine with the margin hit as long as you're focused on your value proposition, selling brands that people love, opening locations that are easy and accessible for consumers. So what are my thoughts on the valuation from here? And so first of all, look, this stock has gone up crazy, and I'm a little frustrated because I was going to post it earlier, and then what ended up happening is they announced that the SEC approved the registration statement. So I was like, they beat me to it. And so then the stock popped a little bit on it. But still, I still bought shares today, around $38 a share. And so this might be top ticking it for all I know, at least in the near term. But, as I look at their growth profile where, let's say I'm penciling out $525 million in 2020 revenue, 140% growth for the year. Don't know what fourth quarter revenue looks like. A big question becomes is what's the growth rate in 2021? Because you can look at the consensus figures, which are around 800 million. But if they're able to grow, let's say north of 70%, then I think this is quite attractive valuation. Because then, what's the implied optimized margins here for a business that has 50% plus gross margins? So I think, especially when you have brands here that are quite lucrative. So, I'm putting 20 to 25% operating margins. I might be a bit high on this. You can tweak it yourself to see, how you'd want to think about it. There's an e-commerce aspect to it as well, which might contribute to a higher margin. So, I look at this and I'm playing around with the different ideas. If you were to tweak, this margin down a bit, but still have this growth rate, I'd argue it's still a very interesting valuation. I mean, one could argue that the growth rate could be in the 70 to 100% plus range because New Jersey just legalized weed for recreational use start of 2021, and that's been a big driver for 2020 as Illinois did the same thing. So what's sort of the growth rate in the years ahead, over the I'm once again taking a 5-year outlook like I do with all companies because I like to have a multi-year perspective. So one is this sort of I think this is a super conservative figure, 15% over the next 4 years, and that's doing 15% and 20% margin and 20 times, which one would argue is very conservative for a hyper-growth business, and at this point, very cash flow generative, gets to 50% downside. So you're thinking, well, like, that's my downside risk, is that for some reason growth just completely falls off a cliff. Their return on invested capital isn't great, so they're not able to grow at a good clip, and they're not able to get the full margins that they could potentially get. So like that's how I'm thinking. Now, of course, could it go higher or lower? Absolutely, than the range. But as you know, I want a mental, logical framework for how I think about this. And oftentimes stocks do go above or below my range, so that's worth calling out. But I think, look, I have low, base, high, and crazy high, where it's like, look, if their growth rate next year is closer to 100%, which is, a reasonable deceleration. I mean, this deceleration is going from 140% to 70%. That means you're losing half your growth rate. Going from 140 to 100%, that strikes me as a little bit more, potentially more reasonable, especially with New Jersey. So then the growth rate, in the years ahead, 45%. So, looking at this in the 35 times multiple, this scenario, this crazy high scenario gets to, several 100% higher return from here, even after the stock has gone nearly parabolic, so far this year. Whereas a very conservative scenario says down 50%. So this is the type of situation where I'm wow, there's a lot of moving pieces, but there's a business here with organic hyper growth. There's a lot of stocks out there that are able to put up really great growth figures, but they're doing it the wrong way. They're doing it by merging with other companies and constantly buying other things and hoping that they can sell their stock and, using expensive debt. Here's a company that doesn't need to do that really as much, in my opinion, where they have this organic growth, 65% same store sales from their existing stores. I mean, that's a very strong growth rate. So I see this, I look at this and I'm thinking, I like how this situation is developing. I like this setup. Is this something where I could say, hey, I'm going to make a big bet when I think there's 50% downside on a conservative basis? Probably not, especially as the stock has gone straight up. But I do think I want this as part of my journey. And let's go into a couple of these components. So what are some of the catalysts for this working out? One is they refinance their debt. Their debt is very expensive right now, 12% plus. They've talked about how they can effectively double their debt and refinance it at 6% and have the same cash interest expense, in which case they could use their capital, redeploy in opening new stores. And as I mentioned already, they have a pipeline for more than doubling their store base. So this is like super interesting idea for capital. Another aspect, which is a big component, is that the SEC approved their registration statement yesterday. Next up is getting a listing on a major U.S. exchange. That could further cause actual buyers to step in and say, okay, this is now on a U.S. exchange. We can buy this fairly easily versus this is a ADR that trades in the U.S. over the counter. It's primarily a Canadian company, just as it's a U.S. company, but it trades in Canada and it has this U.S. ADR. And then the other aspect is national legalization, where it would make it easier for the capital markets, certainly. I would expect you'd probably get a pop in all likelihood from that. But actually, from a fundamentals perspective, I'm not sure how great it would actually be for Green Thumb shareholders. I kind of like this slow rollout process, which is, it's sort of this weird legal state of like, on a federal basis, it's illegal. On a state-by-state basis, they can decide for themselves. But I like the fact that they can prove themselves with a handful of licenses that they can pay for the medical licenses. And then when the state converts and says, hey, we need money, and by the way, the general population wants it as well, then they can get preferential treatment. So I like, if they flicked a switch overnight, I think that would actually create more problems versus sort of this tiered approach slowly over time, where slowly but surely the whole US is covered with legal states. So it's only a matter of time, if I were to guess, before it's nationally legal. But how that plays out does affect how competitive it will be, and how competitive it will be will obviously affect sales and margins. So how am I playing it? So I don't like chasing stocks that go straight up. I mean, it's up over 40% year to date. Maybe it's closer to 50% now, but it is hyper growth. See, that's the part that's challenging, is like when you see something that's up 40%, but you're also modeling out, let's say 70% growth in the next year, that actually means that your valuation could be pretty much flat or even lower, based on where you were. So that's the tricky part about looking at situations like this. If they're able to post 70% plus growth in 2021, then I would argue it seems reasonably valued. So that is the big question mark, is what's going to be their growth rate in 2021 with New Jersey legalized. So I just today, it says I'm thinking I'll make it a starter position. So I just today bought 0.25%, so 0.25%. I'm still thinking it over. I personally, once again, I don't like the stocks that are just straight up like this. I think that creates the risk that, you get these overexcited buyers, and then a week or two later you're able to buy it 20% cheaper. So maybe I'm being a little too greedy. I'm not sure, but I would still think about buying more, especially if I can get a little bit better of a risk reward. But I did buy a little bit today, as I think it should be part of my journey, especially as they're doing what I think could be the steps to build an unrivaled value proposition in a hyper growth market that should be a multi-year tailwind for them. So I like the setup. I like the potential of several 100%. I like the fact that my conservative assessment is sort of like, hey, 50% downside. Look, of course, could I be wrong? Could it go lower? Of course. But I like, the setup that I've got there. I'm not quite at the position to make it, hey, let's say a 5% position. And like a little known fact, like with my C position, which is my number one position in my portfolio, that started off as a 2%, about 2% position in my portfolio, where I was impressed with their growth rate, but I was uncertain about the profitability that they would ultimately convert in their e-commerce segment. And so I was like, you know what, let's put it at 2%. And if it works out, then I'll be happy. My portfolio will be fine with it. And now it's my largest holding in my portfolio, around 8, 9, 10%. And so, I look at that, and that's purely a function of them executing in a little bit of valuation expansion. So, some people might criticize these starter positions that I do, and I totally understand that. But it sort of comes down to the idea that I'd rather have a little bit of something, especially if it's unclear to me that the value proposition has fully worked itself out yet. I'd rather have a little bit of something and have it work out, and then have a little bit of something where it doesn't work out. In contrast, if you have a lot of something and it works out, yeah, that's great. You made even more money. But if it doesn't work out, whereas here it's sort of like letting, by starting it with these smaller positions, it sort of lets my winners slowly take more and more percentage of the portfolio. And so that's how I like to think about this. Would I think about buying more if it were to dip? Absolutely. I am happy to have a starter position in it. I do like the fact that I think there's several 100% upside. And look, going back to this, I don't think this is like 40 times. If they post 100% growth 40 times, like there's a good chance if folks start looking out at 2021 and people are like, you know what, this growth rate is around 100% this year, I think there's a real chance you do get animal spirits on this, especially with the prospect of a U.S. formal listing like on the New York Stock Exchange. So I like that aspect, that you do have that like things just go bananas aspect, and where the valuation just goes crazy. So there is that aspect as well. So it's part of my journey right now for all the reasons I mentioned, and I'm thinking. So I have effectively just a 0.25% position now. I would think about adding more, and I'm going to be watching it in the days ahead in terms of potentially legging in buying more based on getting better prices. But maybe I'm being a little too short-term greedy. We'll see. So I hope this video has been helpful. I'm glad to be able to share with you another potential multi-bagger idea. I'm still planning on doing a full detailed video on CDON, but I know a lot of people are CDON. I know a lot of people want to see that, but they were also curious about what's a US play that I'm doing. So anywho, I said that there were 2 different companies I was looking at. I've bought stock in both, and so glad to be able to share this with you. I'm so grateful to be on this journey with you. You can always email me at journey@unrivaledinvesting.com, and thank you so much for subscribing.